Hey guys, Happy New Year to you. But before we jump into projections and moving forward into 2021, I want to take a step back and look at the year of 2020. All the fears and uncertainties that we had in our housing market and how the housing market made its way through and the foundation that we're sitting on as we leap into the new year. Buckle up and enjoy the ride.
I keep it real, I keep it real, I keep it real, just keep it real.
So it was pretty clear in early 2020 that the coronavirus and our economy were going to be pretty affected by it. And so one of the biggest things from a housing standpoint that we were kind of looking at and combating was a healthy dose of recency bias. As it became more and more evident that we were moving into a recessionary period, people started sounding the alarm and saying that there was going to be another housing crash, and there was just a ton of fear and uncertainty being involved with this. And it didn't help that it was a ton of fear and uncertainty that was being perpetuated by real estate professionals and people in the industry, people in other financial industries and things like that. I want to point to a comment by Susie Orman, who was really negative on this from the get-go, talking about don't buy a house this year or wait till the end of the year because there's going to be so many foreclosures. It's going to be just like 2008 and 2009 where people are going to get foreclosed on left and right. So that was the kind of fear up front in the housing market as things were becoming evident that the economy was going into a recession, that coronavirus was here to stay and going to be an issue for the time being and the future to come. And so these were the types of things that we were combating. But the fear and negativity, anytime there's uncertainty, you're going to have fear. But there was really no basis to some of these claims. No one put the energy into really thinking deeper into the process. They just were thinking back to the most recent recession and what the effects were from that. So one of the first things that we looked at here was, what does history show us? We can look back at 2008 and say, yeah, that was a really negative time for the housing market. But that was just one of many recessionary periods that our country has been through. And really, it was quite a unique recession as well because it was predominantly caused by the housing market, the lending institutions, and things like that. So it can't say it's an apples to apples comparison. So historically, what happens during recessionary periods in America and how is housing affected? So we look back at the five most recent the five most recent economic recessions and how that affected the appreciation and the values of real estate. And so you can see only two recessionary periods out of the last five truly affected housing. One of them was very minimal. The other was exorbitant, and that's where the recency bias is coming in, is because 2008 was so painful to so many of us. That's understandable to kind of have that recency bias. But historically speaking, real estate has survived recessionary periods extremely well. And now that we're at the end of 2020, we can throw this year into the mix and look at it in context of the last six recessionary periods. And we can say housing has performed phenomenally this year. We've had over 7% appreciation across the nation in housing, and it's survived extremely well. And actually, the housing market actually infuses quite a bit of money into the economy. So it's really helped the economy pull itself out of this recessionary period as well. So as you can see, historically speaking, there was a lot of fear early on, but if we just took the steps and the time to look back, it paints a little bit better picture for us in the long run. One of the next big questions of uncertainty and fear that we had was regarding forbearance. This was a pretty unprecedented move for the government to offer this program for people, but forbearance was offered, and so a lot of people took that to mean there's going to be large amounts of foreclosures. People aren't going to be able to ever pay their mortgages again, and the bottom's going to fall out of that. So, this was probably my bigger concern of uncertainty, is how the forbearance sector of things was going to work its way out. But we do have some data now that we can look at. We're still kind of figuring this data out as it moves into 2021, and it will continue to be a topic and something that we continue to monitor in 2021. But here's some of the data that from expectations to the way things really went. But first and foremost, the expectation of how many people were going to utilize forbearance was extremely high. So that was kind of where the initial fear point came, was that they were thinking people were going to use this wide sweeping across the board. They were projecting 30% of mortgages would be put into forbearance, but the actual peak didn't even reach 10%. The actual peak was about 8.6% that actually utilized a forbearance program. And once they were in that program, a lot of people realized they didn't need it. And so the actual current percentage then is 5.5%. So you can see that's a far cry from the initial fear of how broad this program was going to be. But it's still something we're monitoring. It's still something that will probably bring some foreclosures to market in 2021. But we don't expect it's going to severely affect values in the housing market in 2021. And we'll talk about that in our projections video as well. But at the same time, looking at the forbearance and looking at these percentages and things like that, I kind of want to look at a breakdown then of kind of where these forbearances are coming from and where the risk is, where the high risk is and where there's not risk. So you can kind of see a big chunk of these forbearances realize that they didn't need the forbearance. They've already paid up on their mortgage. They're already out of the program and back current with everything. So those mortgages are at zero risk of foreclosure. Another good chunk, just over 30%, are in some sort of loss mitigation and working out a repayment plan with their mortgage company. So those people utilize the programs. Now they are playing catch up, but they're making that plan with their mortgage provider. And so those are at a much lower risk, still potentially at risk if their personal economic situations continue to deteriorate or not get any better. So they could be at a low risk at this point. But then there is about 14.7% of these forbearances that are at high risk, that haven't made any loss mitigation plans, that could be potential short sales and things like that. So these are the percentages that we're looking at maybe coming to market as foreclosures or short sales or having potential issues and things like that. But you can see it's a small percentage of the whole picture. So even though we will probably see some of that happen in 2021, in the grand scheme, if we look historically at foreclosures, we don't expect to get anywhere close to historical averages of foreclosures for the year as well. So it'll bring some new inventory, and that'll be exciting, and that'll be welcomed to a lot of buyers and maybe even investors in the real estate market in 2021. But we expect that inventory to get snatched up pretty quickly because interest rates are remaining low. The buyer pool is remaining high, very high demand for those types of properties as well. And then the last level of uncertainty wasn't even about the housing market itself. It was just about the economy. When is the economy going to return and get back to normal? And we know at the end of 2020 now that we're not back to normal. But how did the economy recover? So, a lot of people were saying what type of shape the recovery is going to take. Some people said it'll be a V, quick down, quick up. Some people said it would be a W, down, up, based off different waves of the coronavirus coming through and how the government would react with shutdowns and things like that. Some people said a check mark. Some people said an L. Some people said a U. All of these shaped letters that can be put onto a graph to kind of explain things. People were trying to figure out what that would be very early on. And so we looked at some major financial industries and some major financial indicators. And so people like Goldman Sachs, JP Morgan, Morgan Stanley, they all were projecting a V-shaped recovery. And now that we're at the end of 2020, we can look back and we can say it truly was a V-shaped recovery. Now we're not out of the woods yet. There's still a lot of economic issues. There's still a lot of industries that are being affected. But from a national economy standpoint, from that standpoint of things, the economy has recovered quickly and has recovered well. And so finally, the last piece that I want to cover here is I want to talk a little bit more in depth and give some more data about why our current year 2020 going into 2021 and all of the economic issues and things like that we've had fighting the coronavirus, why this year is not like 2008 and 2009, because we've got some great data, some great resources that really show the difference between these market times and the effects that it had on the housing market. So first and foremost, one of the things leading up to 2008 was home price appreciation was extremely high, almost in double digits all the 5 years leading up to 2008 and 2009. Whereas currently, leading up to 2020, we had pretty steady, pretty standard housing appreciation across the board. So it wasn't exaggerated. It's been good appreciation. If anything, 2020 saw a little bit above average appreciation with everything going on. But there wasn't that exaggerated bubble type appreciation that was happening leading up to 2021. So the next chart that gives us some positive indications is the supply chart of the available inventory supply of homes available for sale. And you can see how big of a spike it became in 2008 because of the housing crash. That's because of all these short sales and foreclosures that were coming to the market in those times. But even through our current recessionary periods in 2020, you can see that inventory remains super low. So even though people might have been finding themselves in difficult financial constraints, they were not in a spot where they were losing their home. A lot of people still had great equity in their home, so they're able to sell it rather than get foreclosed on. So you can see that supply remained super low. That's another great indicator of why 2020 is a far cry from what 2008 was. The next one that I think is a huge indicator is the amount of equity that's been cashed out of homes. So leading up to 2008, you can see how much money in billions was being pulled out of mortgages. People were cashing out their mortgages. They were taking equity out of their home and they were spending it on things like second homes, cars, motorcycles, toys, all these types of frivolous things because of how great the economy was. But you can see our current years leading up to 2020 has been much more conservative with these cash out amounts. Our total with the running 3-year total leading up to 2020 is just a little bit more or about equal to just 1 year of what was leading up to 2008. So what that tells me is that homeowners are being more responsible with their equity. They're being much more responsible with the value and the money that their home is worth. They're not just using it as a piggy bank and smashing it open to go buy, whatever next bright shiny new toy that they want. And then lastly, and I mentioned it just a little bit ago, has been the overall increase in home equity, because home values even through these economically difficult times have continued to rise. And so even though homeowners might be in personal economic constraints and might be having economic difficulties inside of their household, their home itself is appreciating in value. So if their home is appreciating and they can no longer afford their mortgage, does it make sense that they're going to let a bank foreclose on their house? Or would it make sense that they'll just sell their house if they're in that deep of constraints? So that's a huge indicator. People are actually sitting on a more valuable asset today than they were in 2008. It's appreciated healthily and has continued to appreciate even in these difficult times. So that's one indicator that tells me that not nearly as many homes are going to hit the foreclosure market as we saw in 2008 and 2009, because the housing market is so healthy right now with home values and appreciation. So that's it, guys. That's a little rundown of kind of where things were in 2020 and how we've progressed over the year. There certainly was a ton of fear and uncertainty early on. We were able to get a good idea of where the market was heading shortly after that, and all indications were pretty positive. I know there's still a lot of bad going on. There's still a lot of negative things from 2020 that will carry into 2021. But in regards to the housing market, it continues to be a great investment. Here in Fort Wayne, our housing market continues to be extremely healthy. Buyers are looking at extremely low interest rates as we continue into 2021, and sellers are looking at a market where home values are still going to be appreciating in 2021 as well. So lots of great things to look forward to. Stay positive, stay optimistic, stay healthy. God bless y'all, and everyone have a happy new year and a great 2021.
Just keep it real.